Welcome, Tushar. Thank you very much for joining us. A couple of questions that we have, sir, as we move into the new year as to what we can expect in 2024, given that there will be elections and stuff like that. It's going to be a very exciting year, according to us. So, if you could just give us an overview of 2024, starting with the equity market. So, what do you think the equity market will look like? How will they pan out?
Yeah, it's an interesting question, but let me tell you that the equity markets is not one market. So there are parts of the market which move in different directions. So if you ask me, people say, well, the Nifty is reasonably valued, right? So, but the Nifty is made up of only the top 50 companies, so which haven't moved. They have moved a little bit, but that reflects in the overall movement in the Nifty itself, which has been around 11-12% for the year. But the real action has been in the mid and small caps, where some of them have doubled, tripled just in a 1 year time frame. So when you ask about equity, I have to kind of incorporate all of them together in that answer. So in a sense, I would think that clearly over time, markets only follow earnings growth. Right? So that's a safe thing to say that if earnings remain robust, the multiples remain where they are, I think we will be, having a pretty good year. But if you look at history, after every year which has been pretty significantly positive, you know, the averages catches up. So whether this catch up happens this year or not, nobody knows. But to counter that, the issue in terms of where the fundamentals are, they are surprisingly very, very strong for India right now. I say surprisingly because many times all of these things don't come together very well for India. Either interest rates remain high, or the currency remains weak, or there is always some fly in the ointment. But in this case, I must say that there is a significant positive across most parameters too. So if I were to say like, what is the reason why the market will not do well? I can't really find any one fundamental reason. But markets are markets, and they get affected by external factors, geopolitical events, and so that's going to be a little bit of an uncertain environment. Having said that, there is also an election year, as you mentioned, which always lends some sort of volatility in and around that event. So I would expect that it's going to be a volatile market, and more importantly, I would think for the equity markets, what is going for it? One, earnings will remain robust, and here I'm talking about across the board. I'm not only taking mid caps or small caps.
Right.
I'm talking across the board. There will be pretty significant robust earnings growth. On top of that, valuations in some companies are a little expensive. So you have to understand that stock markets don't necessarily follow logic at all time, but over time it is very logical.
Right.
So here what I'm talking about is that for some time you might appear that as if it's an expensive market because obviously valuations have run ahead of earnings growth. But if the earnings growth sustains, then you will have a more gradual kind of earnings scenario, which ensures that your markets are also going to react positively. But not to the extent when it first sensed the earnings growth, which is, where it front ends, let's say, for a lack of any other word, the momentum in earnings and price. So I would think that 2023, especially in mid caps and small caps, was that first spurt, that it recognized that earnings are going to remain resilient. Now, if you take the next year, it might taper down, but it's not going to go down. But the kind of returns that you've seen in small and mid caps, I don't think they are going to sustain for this year. That I think we should take as a reasonable expectation. And on the other hand, you might have surprises where, especially in the large cap space, things haven't moved much, where you might get an earning surprise that you might actually even get an above average kind of return possible. So which means you can understand how the complicated question is that across the board there is not one thing that I can say. But I think it's going to be an interesting time. Fundamentals are clearly positive. So the only thing which will maybe change the picture is that something external, something that we don't know right now. It's like an unknown, which can possibly alter the market no matter where the earnings are for that time. So given that, I think we should be in for a good time this year.
Okay. So moving to the fixed income side of things, how do you see that panning out over the year?
Yeah, so there is a difference I would like to make between what's happening in fixed income globally and what is happening to fixed income in India. So as you understand, globally interest rates went up dramatically last year, right? So, or this year, as we are still in this year. But in India, the interest rate increase was more gradual because in any case, we are a significantly higher interest rate environment. And we didn't have that much of an inflation spike as much as what the Western world has experienced. So as a result of which our interest rates movement was pretty gradual, but it went up. And now you're seeing a very dramatic shift in the policy environment in the US, leading to a significant drop in market rates. And then eventually people are talking about even policy rates to come down sometime next year. Now that represents, global equity and global bond market liquidity. Now, if that moves down, then there is going to be a surge of liquidity which will be released in the system. And that remains a very big positive for emerging market debt as well as in India, which means that interest rates even here may start to follow what the Q is globally. In India, of course, the Reserve Bank of India has been very good at managing the interest rate scenario and especially the liquidity scenario. So given the fact that we are expecting higher growth than what was expected earlier, there may be a little bit more of an intervention that the RBI will make so that inflation doesn't take off, because as growth grows up, you understand that inflation also goes up. So here we are at a different level than where the global interest rates are likely. So it's going to be an interesting point. However, I must say there is some buffer left in the armory for the RBI to continue to kind of start to at least signal a little bit of a lower interest rate regime, but it will continue to remain pretty much where it is, at least at a 10-year level. So I would think that it might be interesting to start allocating some of our growth capital into fixed income at this time, but I think more or less the YTM is what you should expect from fixed income this time.
So we've covered equities, we've covered fixed income. Let's look at gold. How do you see gold panning out? Because traditionally when equities goes up, gold goes down, so on and so forth. And gold has not been the best asset class over the last decade or so. So how do you see gold panning out? Also, so where do you see the Indian rupee vis-a-vis the dollar? How do you see the currency situation also panning out?
Okay, so before going there, I must say that I'm no expert in these two commodities, but from what I gather, I can tell you that gold has been a very interesting asset over time. And you have to remember that gold is not a pure return asset. Gold is always included in a portfolio to reduce the risk of a portfolio. So whether it's interest rate, whether it is the equity volatility, when you want something which will hold a store of value, people gravitate towards gold. Which means when financial markets are in trouble, people tend to allocate more to gold because it sustains the value of the portfolio. It does not make you higher return. Though, for a lack of any other thing, when you see the number, you say gold has returned so much. Gold actually doesn't return anything. It is just the value which people perceive in it as a asset of choice when there is uncertainty in the world. Now, there was a lot of uncertainty last year, and I think that uncertainty is likely to persist for some time. So that will continue to hold some value in gold as an asset for global allocators. But again, it's not like a go-go, asset class to invest in because it will make money, etc. Indians, of course, view gold very differently, so they might want to continue to hold it for whatever personal reason it is. But if I were an asset allocator, I will keep that in mind, that gold is always an asset to reduce the overall portfolio volatility, not to give it legs. So if you're thinking that you're going to be global turmoil in elections are likely to be very, very volatile, or a very surprise outcome is likely, or whatever it is, then allocating to gold makes sense because that will reduce the volatility.
Basically acts as a buffer to the
Absolutely. It's a store of value, which traditionally it was. So that's my view on gold. When you talk about currency and the kind of view, the rupee versus the dollar, that's something which again I struggle with, because traditionally the Indian rupee has always depreciated against the dollar. That is because the inflation in India has always remained significantly higher than in the US. So that generally follows by theory that your currency will weaken over time. But as we saw that there was a dramatic rise in inflation in the US, and that led to this situation where we haven't lost so much value in the last year, for example, versus the dollar. Now, if inflation starts to come down in the US, then it is likely that the currency, especially if inflation in India then goes up, then it is likely that the currency may weaken just based on this. But there are many other factors which determine, the rupee dollar equation, whether there's demand for rupee when foreign investors come in, or where there is a flight of capital, which again weakens the rupee. And the flight of capital is not really just flows, but it could also mean that if commodity prices, especially oil price, goes up dramatically, then there's a drain on our reserves, and that also weakens the rupee. So there are so many elements to it. But I would think that the overall difference between inflation levels in India and the US will continue, which means over time it will be, kind of depreciate in a very, very gradual manner, which I would think that it leads to some spikes in between, but overall, I think that should be taken as a given.
Right. So you spoke about the US, and there is always this BRICS term that keeps coming up, and the membership has increased, etc., etc. So where do you see the India growth story kind of pan out? Because as of now, we seem to be doing pretty well as compared to the others. Do you see that continuing in 2024, or how do you see that panning out in a so the quick global overview, and where do you see India in that global picture?
So I think globally, asset allocators will have a problem this year because last year practically all asset classes did well.
Right.
So typically they always then review that which did the best, which I think in all things cryptocurrency also did very well. People will tend to take a pause to say that what else looks good. Emerging markets have not done well, and for reasons, for the fact that they were not in the best position to take advantage of trade flows, etc. But when you talk about BRICS, the membership is changing, and the S now, instead of South Africa, now stands for Saudi Arabia. So this keeps also evolving over time. But I think India should be taken a little differently than each of the other economies at this time, even if you bring China into the picture. That India is experiencing a different state of growth than even China is, because China is actually plateauing. It continues to grow very strongly, and by absolute terms, it's still very, very far ahead of India. But I think India is entering a stage where it will sustain a level of growth, which is again led by its domestic economy, and it will provide the kind of sustainability which most of the other economies are unlikely to have. The other economies, especially if you take Brazil, they are extremely export oriented, agriculture, commodity driven, etc. So that makes it very volatile. If you take some of the other BRICS inside of that, it also is not really very consistent growth that one can talk of. They are going to be all over the place. So I would think that India stands to be a much better position right now, and will be for some time versus all of the others. So I think India will be taken separately, because if you take the last decade, India has delivered pretty significant growth, both in economic terms, in market terms. So I think India is starting to pull ahead of the BRICS as such to being pulled. And of course, there's a whole debate about India trying to become a developed country in some time, or $5 trillion in GDP, etc. So I think we are on a different path as opposed to some of the other countries. And you have to remember that the other countries will have a cap on growth. So if you take South Korea, for example, or if you take Malaysia, Singapore, any of these other developed, sort of semi-developed Asian economies, they have a problem of growth because their populations remain fairly stagnant. And their economies also then, as a result, will only grow at a certain rate. In India, while the population is not growing, the penetration of higher income households within our population is dramatically improving, which means it is giving legs to the economic growth without actually having to grow the economy itself by any other means. Right. So that is not so much evident, say, in Singapore's case, where the per capita income is not going to dramatically rise as an average, or for that matter, even South Korea, because they've already reached a significant level. In India, that is what is different. So I would think that I would take my bets properly if I were a global allocator, and then distinguish between emerging markets as a label, and then try to select some economies which will do much better than others.
So a quick summary of what we've just discussed. What would your advice be to an investor who is maybe looking to invest in market for the first time, or even a veteran investor who's been there, what should they do in 2024?
So I think the situation changes every time. So whatever I will say will change the next day. But having given that caveat, I would think that purely from a valuation perspective, I think the large caps within India in equities remain a little more attractive. I'm saying a little more because it's not as if they're cheap either, even compared to history. But there may be pockets of reasonable valuation which can, suit a seasoned investor well to put their money there. And of course, on the mid and small caps, there are opportunities. It's such a wide universe that there are always companies to look at, but they become very stock specific. So again, the seasoned investor, as you mentioned, has a lot of work to do. There is plenty of opportunity. But for someone who's starting off, I think they should not concentrate on where they will make the most money. I think they should concentrate on understanding their own risk appetite. They should understand that equities is a longer term allocation. So if you're starting off, if you're a 25-year-old, 30-year-old guy who has discretionary savings for the first time, uh, I think they should find out for themselves what risk they want to take and then allocate to the equity asset as a significant portion of their long-term savings. I'm not talking about what they need to do to buy a car tomorrow or whatever. I mean, that's all savings. But they have to understand that they have time on their hands. And no matter where the markets are, and that's something very important to remember, even if it is an all-time high, it does not matter. That if they are planning to invest for the next 10, 15, 20 years, then their allocation to equity is regardless of where the market is. So this is not a question for the newcomer to say, oh, is this a good time to put in money in the market? No, every day is a good time if you're starting off and you understand what your allocation is be and go ahead. So that would be my advice to those. From a fixed income perspective, I think investors are more or less aware of the kind of yields that they're getting in funds at around the 2-year, 3-year mark. I think those are the funds which continue to deliver over time. So again, understand it's part of a allocative strategy, not a pure return. You have to have growth and you have to have yield. So everyone has to decide on that basis. And I think if someone wants to be a bit more, I would say, adventurous, then one can look at sectoral funds, try to see the trends there and put some money there.
All right. Thank you very much. Thank you, sir. Thanks for joining.
Thank you very much.